Hello and welcome to another one-to-one mining investment content session. Today we're going to be hearing all about precious metals investing. So as the COVID-19 pandemic has triggered significant impacts across all business sectors and a rapid sell-off in financial markets, we want to hear about how precious metals fund managers are interpreting this unique period. So joining me today, I'm very pleased to be able to draw on the expertise of Angelos Damascos, CEO and founder at Sector Resource Managers, and Ian Williams, CEO of Charteris Treasury Portfolio Managers. Gentlemen, thank you for joining me for a chat today. So getting into the first topic, I'd like to start off with a discussion looking at how are you finding the macro picture at the moment? Is this velocity of macroeconomic policy creating a very positive environment for precious metals? And do you see that environment continuing for the long term? Angelos, perhaps you want to start us off?
Yeah, sure. Well, we obviously live in unprecedented times. It's very difficult to forecast how the economy is going to fare going forward coming out of this pandemic crisis. But what is becoming clear is that we are rapidly going into a very deep recession, and the question is how long will it take for the economy to recover? I think with regard to precious metals, obviously it is a situation in the world that has caused a lot of grief and a lot of damage economically and health and physically to many people. We grieve for people, many people grieve for people, relatives who've lost, etc. So no one wants to dwell on this situation as a happy event, but under the circumstances, the precious metals are fulfilling their role as a safe haven and store of value. And in my mind, the most important catalyst to look forward is that the global bailout packages launched by governments and central banks so far add in excess of $12.5 trillion. Now, most of that money is essentially life support. It goes to bail out companies to keep people in good health and good sort of financial position while they're unemployed. So effectively, it is not money that is invested in productive capacity. It is life support. So once we start trying to come out of this crisis and start to find ways to come out of the recession, we will probably be looking at a much smaller productive capacity, as many companies will have shrunk or gone out of business. And also, we will be looking at a massively increased debt load around the world. So all of this is likely to result into some debasement of the key currencies, US dollar, euro, the yen, etc., and therefore be very favorable for precious metals, particularly gold. In addition to that, the central banks are unlikely to be able to increase interest rates under the circumstances, trying to stimulate the economy. So that's another tailwind for precious metals. So I think it is very likely that we will see a very prolonged and very strong bull market for precious metals.
Yep. And with that, do you see the price of gold perhaps going higher anytime sooner, or do you think that initial rush to the safe haven asset, as you said, has sort of plateaued for a bit, and now we're going to see how markets react during this ease up of the lockdown period?
Well, if we look at the trajectory of the build-up of gold bullion ETF holdings, it has risen almost exponentially in the last 6 to 9 months, and it indicates that a lot of investors are acquiring gold bullion as the core safe haven asset. So I believe that we are just at the beginning. There'll be a lot more demand for gold bullion, and given the shortage of supply, prices are going to go significantly higher.
Yep. Okay, we'll come back to that bullion point in a minute. I have a question around that, but Ian, let's bring you in here. What's your take on this macro picture at the minute? Do you agree with Angelos that this is going to be a long, protracted recovery, or do you see things perhaps being more favorable in different jurisdictions, different markets, China from the US, for instance?
Yeah, well, there's two countervailing forces at work here. One is the close down effects of the virus all over the world, but it's being met by an equal and opposing force of central banks printing money all over the place. And it's the money printing, it's the antidote that's driving markets at the moment, not the virus. And that's why the equity markets are riding high. I mean, not just gold shares. Gold shares are all up year to date. Some of the big blue chips are up quite sharply year to date. But the Nasdaq's also up year to date. So you've got these fund managers, and this is just all fund managers, who are trying to look at the economy and then relate it to the stock market, and sitting in cash and 2-year bonds are getting it wrong. And that's why they're getting it wrong, because it's not the virus and the news about the virus driving the news, it's the liquidity that's driving stock prices. And perversely, I know it's counterintuitive, but potentially the worse it gets, the more money they print, and the more inflated the asset prices become, because that's where the liquidity is going. So the biggest beneficiary of this is going to be gold and precious metals. But the general stock market's also a beneficiary of this. And the big losers here are people who hold bonds, and any kind of bonds, or sit money in cash, because that's just going to get devalued and left behind.
Yeah, so if you're cash or you're holding bonds, look to physical gold or gold equities, you say?
Yeah, well, or any equities, gold is, if this is the amount of money being printed at the moment is unprecedented, and it's very, very difficult, even if you allow for a falls in velocity of circulation and all sorts of other things, it's very difficult to see how this is not inflationary over the medium term. Right? So all inflation-proof assets potentially are going to rise here. Gold's obviously the leading one, and gold miners. But there's other inflation assets. Silver and platinum at the moment are also just as inflation-proof as gold are, as is copper and zinc and nickel. There's lots of other assets here that are inflation-proof as well, and they're being ignored at the moment.
But for most investors, you wouldn't be buying sort of physical copper necessarily, unless you're trading or in that. But so you suggest look at the copper producing companies.
Absolutely, yeah. But that's the next phase of the game. I mean, gold's going to move first. Gold's already moved first. And I'm not bearish on gold. I think gold is going to have a wonderful next 12 months. But it is getting the valuations of gold relative to silver, relative to oil, relative to copper, is getting a bit stretched. I mean, gold is virtually rising in isolation here. And a lot of these other inflation-proof plays are just been ignored. And so while I think you make a lot of money in gold shares, and it'd be interesting to hear what Angelos says on the smaller companies, because all the play so far this year has been in the big blue chip miners, and you haven't really seen these smaller and medium cap ones really perform as well as the blue chips. So I think gold's going to continue to go up, but I think you'll make more money in the mid cap and small ones from here on, and you'll make more money in silver miners than you will in gold miners, because I think silver has a lot of catching up to do.
Yeah, so you're looking for the capacity to grow, and gold's sort of dragging everything else with it.
Yes. But in percentage terms, not go up as much as the others. It's a first leader, it's the first mover, but there's other games that are going to come into play here where you potentially can make a lot more money as an investor. That's not to say you won't make money in gold. I think you will. If you just bought big blue chip gold miners, I think you'll do great. But you might do even greater if you look at some of these other things that are going to come into play at some stage, if this is a proper bull market.
Do you think with the restrictions that are going on for transportation, operationally, the restrictions that are going on because of this crisis, that could actually hurt some of these companies that are just about to come into play, maybe on the developer side, maybe even earlier exploration stuff that's got this added risk layer of not knowing when to get back to work normally. So that might inhibit gold dragging them up.
Possibly, but possibly not. You see, if you have a 3-month moratorium on activity, if it's something like a hotel or an airline, that's money lost forever. EasyJet never going to get back the fares that people haven't flown around. Whereas if you've got a silver mine, something like Mag Silver or something, which has got a huge, great lump of silver and hasn't yet come into production, if you get shortages develop in the silver market, the price of silver will go up. So there's silver in the ground is rising. So although they might have a 3-month moratorium extra on producing it, what's in the ground is going up in value. So when they do get round to selling it, they potentially sell it at a higher price. So moratoriums affect different industries in different ways. And this, even if they can't produce for 3 months, doesn't necessarily mean it's bearish for them in a way it is for a hotel or an airline company. Does that make sense?
Yeah, absolutely. That makes sense. So, Angelos, do you have any thoughts on the smaller companies in terms of perhaps the disparity of how this is impacting smaller companies from the larger majors? We've seen the share prices in 7 of the majors looking very, very positive. Do you think that's going to continue? Is it going to trickle down to the junior tier, perhaps a little bit more?
Well, on Ian's point, obviously we know that last year was not a very good year for smaller gold and silver mining companies. And the main reason for that I attribute to, firstly, the sort of the initial stage of the bull market in gold and silver that developed from June of last year, really. That caught many people by surprise and tended to focus on the larger capitalization companies at the initial stage. The second factor is that, of course, until about early February this year, we had a very strong equity market. We had a massive bull market all around the world that detracted attention of investors from mining shares, even including the gold mining companies, notwithstanding the rising gold prices. Since the turn of the year, though, we have seen a dramatic shift and change in the dynamics of investors looking at the sector, and we have seen greatly increased interest in middle and smaller capitalization companies. So, and it is natural, it's the natural evolution of the market that once the majors have had a strong run and have risen to fair value or perhaps to an overvalued territory, however you want to look at it, investors will gradually switch their allocation to spread it more evenly across the spectrum and look at the smaller, middle and smaller capitalization companies. And we have seen this happen during the course of the last few months. I think it's going to continue. So I think the smaller capitalization companies have a lot of potential to catch up and even outperform the larger ones. And the main reason for that is that we know that the majors are, have finite life in their capacity. We have seen an average grade diminution across the industry, so they are obviously mining more than they can find. And given the input of the very strong bullion prices, most executive teams are now looking for growth, and the easier growth is to acquire smaller companies.
Yep. So you think this could be spur on M&A actually within the gold sector?
Absolutely. The M&A activity started in the last 3-4 months in the larger middle capitalizations segment, so to speak. And we have seen a few deals being announced lately in the last few weeks that indicate that the mining teams, the management teams are indeed of that frame of mind, that mindset that is looking for growth and is looking for potential new projects.
Ian, do you have any thoughts on M&A from here, from this point on? Do you think it's we're going to see a wave of the smaller, better positioned assets plucked up by the majors, and it's going to continue to the next level?
Yeah, this is classic textbook unfolding bull market. So at the moment, because of coronavirus, fear amongst investors is way out. It weighs greed. So you've had generalists come in, they've seen gold price go up, they've seen the costs of gold mining companies go down, which is oil, which is their largest expense in a lot of companies. So you've seen this double whammy of rising revenue and falling costs. So you've had generalists, big insurance companies in America, attracted to the sector. They don't normally play in very much. And so the obvious thing, when fear outweighs greed, and you're not a specialist in the sector, you come in and you buy Newmont, you buy Barrick, because they're the big market cap stocks, big liquidity stocks. They're the ones they know. They're the ones that they think that if they suddenly decide they want to out, there'll be liquidity to allow them to sell it. So generalists will come in a first stage of a bull run, from March onwards, will come in. The blue chips will outperform. That's how it works. Now, as fear gradually recedes and greed starts to come into play more often, attention will then turn to the mid-cap stocks. And if the bull market carries on, the mid-caps, you'll suddenly find the mid-cap starting to do much, much better than the blue chips. The blue chips have already had quite a big run already this year. And then, if it carries on even further, you'll find that even the mid-caps start to get a bit boring if it's really running. And then the exploration shares, the really small ones, will take over, and they'll start outperforming everything. And that by that time, fear will have completely gone out the window, and the only concern of investors is greed. So this is a classic unfolding bull market in three phases. It starts off in blue chips, spills over into the mid caps, then spills over into the small one. Now, with regard to M&A, I 100% agree with Angelos. A lot of these big mining companies are on declining production profiles. So the only way they're not going to make discoveries. They're so big, some of them, they can't make discoveries that make up for the gold they're digging out the ground. So they're forced to take over medium-sized companies that are got, so they can replace the ounces that they're digging out the ground at the moment with the takeover targets. This is why Barrick took over Randgold, you know. And you'll see this throughout the whole sector. And the more you're in a bull market, the easier it's going to be for these big mining companies to get finance and get the market to finance these deals. They'll have investment bankers queuing up at the door, showing them deals. So yeah, it's an unfolding thing. It just feeds on itself. Their cash flows will improve, so they'll be in a better position. And the only downside is that they'll end up having to pay a lot more for the targets that they want to take over than they would have done maybe a few months ago. But when none of this was in place. So.
Yes, you sort of kick-started things somewhat. But just to be precise on your point, where are we in this bull market? We're sort of at the point right now where the majors have had that share jump price, and we're just about at the phase where it's going to trickle down to the mid.
The next phase is it spills over into the mid-cap stocks, and you'll suddenly find that the Newmonts of this world start going up, you know, 1 or 2% here. But all of a sudden, these mid caps are going up 3 or 4 or 5%, and you start to get outperformance then from the mid caps over the blue chip. So I think we're there. I think maybe in the next week or so, that phenomenon is going to kick in.
Yeah.
And so also you got a pretty powerful. I mean, seasonally, gold and silver tend to do much better in the second half of the year than the first half. So it's all kicking in with the seasonal patterns as well. One of the most powerful drivers of gold is the interest rate market. Last Thursday, for the first time ever, the implied interest rate on a 3-month euro-dollar future went negative. So you're negative, the Fed hasn't cut negative rates, but the Jan 2021 3-month euro-dollar future is now signaling negative interest rates. So you can't get anything more bullish for gold than precious metals than this.
Let's talk a little bit about the physical precious metals. How is this the time where you would hold more physical within your portfolio, or have you already established that as your hedge way before this scenario unfolds? And also, who's buying physical now and driving the price up? Do you see it's mostly central banks? Is it a retail market? Is China and India's retail market slowed down a little bit given what's going on at the moment?
I haven't got. I don't know what Angelos got. I haven't got any actual metal in the portfolio. It's all mining shares, and it's a mixture of blue chips and mid caps at the moment. In terms of who's buying the physical metal, I suspect an awful lot of central banks are going to start to copy what the Russian central bank did last year and switch their treasury bonds into gold. I mean, it's just a no-brainer trade, especially if you've got geopolitical risks as well, that you might face American sanctions and stuff. I mean, never ignore all that from a Russian standpoint of view. Just the fundamentals on the trade itself make it worth doing. But then it makes you immune from US sanctions as when they can't confiscate your treasury bonds. It makes the trade a no-brainer. There's a lot of rumors around. I mean, I don't think the Americans would be daft enough to do it, that they're potentially going to sue China for damages over causing this virus and then confiscate their $1 trillion of treasury bonds. I mean, this has been doing the rounds. If they do that, and you can't rule out that they won't, but even if they start talking about it, other central banks are going to look at this and say, hey, this is mad. We're holding treasury bonds. They don't yield anything. They carry a political risk. It's insane not to switch into gold, which has no counterparty risk. So, and this is what the Russians have been doing. This is how it's really worked out for them. So you'll have a load of central banks potentially copying what the Russians have done. It's a no-brainer for a central bank to do that trade. So yes, against that, you're going to have a fall off in jewelry demand because of the virus. So you've got to net that off as well.
I tend to agree with Ian. Like Ian, we don't hold physical gold in our fund because it's a pure equities focused fund, and it's essentially a sector allocation tool for investors in the smaller cap segment. But in terms of the broader market, the data we have seen out of the World Gold Council is actually that the central banks have slowed down their purchases in the last few months as they try to figure out how to finance these massive bailout programs, these massive, quantitative easing programs. Most of the buying has been derived actually from financial investors, which buy bullion via ETFs. And that's why we see this almost exponential rise in ETF bullion-backed holdings. And I expect this is going to continue, perhaps with some of the central bank buying resuming later on in the year once their balance sheet is more stable and they know exactly how to fund their liabilities. But it seems that both generalist and specialist investors are now reallocating their portfolios to more safer, sort of less volatile structures, and gold features as a much bigger percentage. We also have to bear in mind that until the beginning of the year, or in global averages, gold allocation in global portfolios was less than 0.5%. So if we get investors to double that allocation and raise it to say 1% on global average, that's a massive demand for gold bullion, and that could be the sole driver of prices.
Yeah, that makes sense. Total sense. Okay. I want to just quickly touch on oil, actually, the black gold of last century or this century, or however you look at it, and how the oil price impacts might affect mining. Firstly, on the capex side of things, do you think this is going to be a real boost to the mining company operationally for quite some time? And then also, how does that change the landscape on a macro picture? If you think about the energy sector, the US, is it going to reshuffle the balance of power in some respects globally, and then that in turn have an impact on financial markets and then trickle down into precious metals as well?
Me, Ian here.
Sure.
We think that it's not particularly brilliant forecast, but we think the minus $40 a barrel was the low. You won't see it ever go anywhere near there again. So that marked a cycle low in the oil price. There's about a powerful 10.5 year cycle in oil. So it fits in with the big low 10.5 years ago. So that's it for oil. Now you may have a double bottom. It may rally up and then have another sell off, but it's never going to go anywhere near minus $40 a barrel, because in 3, 4, 5 months time down the road, a lot of the storage problems that they've had in storage oil will gradually disappear, and the long-term solution to this is that the Saudis and the Russians between them will have busted the US shale industry, which was their intention. So it might take quite some time for consumption to get back to normal. I doubt if airlines are going to be carrying the same number of passengers for quite some time. Likewise, people driving around, but it will recover gradually, and over time, the oil price will get back up. And going back to what we were talking about earlier on about copper being an inflation hedge just as much as gold and silver, well, so is oil. Oil is a commodity. So if you get generalized commodity price inflation, oil at some stage will join in. So we're actually looking for not for our gold fund, but for looking at potentially buying some oil shares down here. We're waiting to see if you get a double bottom effect. But we think oil shares are now really quite cheap, actually. The ones that are going to survive potentially do quite well. So, but I don't think you're going to get a rapid move up. So the gold miners for now are in a sweet spot where they still get the benefit of historically quite low oil prices to fund their operations. And so where they were paying $60 a barrel a year ago, if they end up paying 25 or 30, that's quite a big saving spread out over a year for your average gold mine. So potentially we're bullish on oil companies, bullish on oil, but over a sort of 2-year view sort of thing. And in the meantime, the gold miners are going to be one of the big beneficiaries of the low oil price.
Yeah, that makes perfect sense. Yeah. Angelos, you invested in oil as well. What are your views in the big picture and how oil prices are playing out?
You talked about the geopolitical balance of power among the oil producers. Certainly, the dramatic collapse in oil prices has a very negative impact on the historically established producers such as Saudi Arabia and Russia. Their budgets have been decimated. I was reading today that Saudi Arabia, for the first time, are having to cut back on their expenditure, the budget for the state, and they are cutting back on things that were considered essential before. And the reason they cite is the collapse in the oil prices and the lack of revenue. So it's not affecting only America that could potentially see the shale industry damaged and significantly reduce its capacity. It is hurting Saudi Arabia and other OPEC producers. For example, look at other less financially robust countries like Venezuela that will be completely destroyed now. They are losing the single most important revenue to the country. So yes, I agree with Ian that given the supply destruction, we see multiple shut-ins now, capital expenditure budgets cut to the bone across the industry. There's going to be a significant drop in supply over the next year or so. And ultimately, once people start coming out of lockdown and start traveling again, airlines flying, perhaps not at the same rate, but still demand starts coming back, oil prices could bounce, and the companies that are able to sustain their operations and remain operationally healthy will be the main beneficiaries of this, because they'll be in an even better position to capitalize on rising prices. So I think it's not, it is generally a very big plus on the economy side, the global economy side, because we see the cost of energy drop. But on the other hand, there is a big cost to it in the sense of the destruction that is taking place in the oil industry at the moment, which could be potentially very dangerous going forward.
Yeah. Okay, good. Good to get your views on that. Thank you. One last thing I wanted to sort of raise on the macro side of things was something we talked about, Angelos, previously, is the sort of parallels between 2008 and a lot of comparisons being made with financial markets and what happened in 2008. How do you look at what happened there and then see the fate of precious metals mining companies and see some similarities with how they're coming out of this current economic crisis?
Sure. Well, we saw exactly a replay of the 2008 crisis in the last couple of months, in late February and March. when gold started selling off because of investors potentially tapping any liquidity they could find to salvage margin calls and to make good any other positions. And we also saw a massive and dramatic sell-off in gold mining shares, including the majors, in fact. Even the majors sold off very, very dramatically in the month of March. And it was exactly what happened in late 2008 after the Lehman financial crisis and the bankruptcy of Lehman Brothers. But and we have seen a significant recovery since alongside the markets. But I think it's going to continue. Drawing the same parallel back to 2008, the gold mining stocks bottomed out sometime in December, well before the general markets bottomed out, which was in March the following year, 2009. And then in 2009, the gold mining shares were the best performing segment of the market. So we see potentially the same scenario replaying again this year. And I take Ian's point about the other potential sectors of the markets like copper, like some base metals, some other precious metals also offering attractive rewards. But I think for the next 12 months, gold and potentially silver are going to be the standout outperformers.
Yeah. Okay, Ian, do you have any thoughts on parallels with 2008, echoing that sentiment perhaps?
Oh yeah, I mean, I wouldn't disagree with any of that, what Angelos said, but the only thing I'd add is that when they did QE1, QE2 and QE3, they did about just under $4 trillion spread out over 6 years. So far, they've done about 2.5 trillion, maybe 3 trillion in the last 6 weeks, with the potentially to do another 2 trillion by the end of the year. So although this is a bit of a rewind, the sheer scale of the money printing this time round is miles bigger, far bigger than anything you saw before. So if you saw, like for instance, silver went from $10 to $50 after the 2007-8 crash on the back of QE1 and QE2. This is far bigger in terms of money printing and currency debasement. So yes, no one would be surprised to see exactly the same replay of what happened. The only thing I would potentially add is that it could be much, much bigger this time around because the sheer scale of the money printing is so much bigger. And that's the rocket fuel that's driving this market.
Yeah, it's concerning, but that's interesting to...
More concerning if you're short.
Okay, let's talk a little bit about mining companies now and precious metals miners across the board. It seems like the bankers are going to be open for business, the lenders are going to be available to help companies across all sectors get through this the current crisis. If I'm a junior miner, where can I look for equity? Is the equity still available the same amount? There was already a transition in the way that capital is being formed for junior companies. Perhaps precious metals sit in a slight exception from the other commodities. But do you feel that there's still equity available out there for companies right now to be coming back to investors or finding new investors? Or do you think there's less than before? Investors are being very cautious. What's your take on that?
Well, mining companies are always looking for money. I mean, that's just nothing changes. Bull market, bear market, whatever. It's only in a bull market, it's a lot easier for them to find it. So if we're right that over the next year we're going to have a really healthy bull market in gold and the rest of the precious metals, I would have thought that the mining companies the good mining companies with a good story to tell won't have any problem at all in raising the capital they need.
And what makes up that good story for you at the moment?
Well, I mean, it's one of the few sectors where profits are rising, revenues are going up, and costs are going down. So you're going to see when they start reporting all their financial returns for the first quarter and second quarter, whereas a lot of other industries are finding their earnings and profits decimated, this sector is going to be showing growing profits and potentially growing dividends as well. So there aren't too many. You've got all these stocks, banking sector and some insurance companies and airlines, all abolishing their dividends. You could see dividend increases in this sector. So there aren't many sectors where you can say that. And the other asset class that people seem to be flooding into at the moment is these NASDAQ shares like Netflix and Amazon. Well, they're on P's. They're on P's of 100, you know. So, you know, you're not buying cheap assets here, where these gold mining companies are still very, very moderately rated. So it's not like, oh, it's too late, you've missed the boat, you're paying way over the odds in terms of exaggerated PE ratios and stuff. The mining stocks are still very cheap, so there's value there as well. So yeah, I don't see any reason at all why a mining company in the environment, if we're correct about the environment, how it's going to unfold, I suspect they're going to be turning money away.
Right, and that's ASX, TSX, AIM listed juniors across the board.
Yeah, I mean, it'll start. I mean, Angelos will know better than me on the juniors because he specialises in that sector. But even some of the juniors that traditionally struggle the most to raise money in a good bull market environment will find it easier than usual. I mean, would Angelos agree with that?
Absolutely. I mean, we have seen a great opening of the market recently. And there have been a multitude of private placings coming into the market in the last few weeks from companies that are at every stage, from exploration right through to development. But where we see most of the demand focusing at the moment is at the development stage. So it seems to me that the market is sensing that the majors and the mid-cap producers will very soon look for mature assets, those projects that are very near the construction phase as takeover targets. And I expect a lot more corporate activity because of this growth question mark we have over the majors and the mid-caps. So I think the market is certainly open. There is a lot of demand for equity for these smaller, earlier stage situations. But as the bull market develops, you know, these are the things that can become frothy because too many investors start chasing the earlier stage companies and then start pushing the valuations high very, very quickly.
Yeah, that all makes sense. Very good. Okay, so one other area I was going to touch on was the ESG narrative that's come across for all, both on the investment side and also company operations side as a reporting standards. How do you see that changing at all, or perhaps running out of a bit of steam as compared to last year throughout this crisis, or is this going to continue to be something that's front of mind across many different funds in terms of where they're looking to place their capital from here on, or would that perhaps be overshadowed a little bit by seeking out shareholder value at the moment?
I think possibly it does. I mean, you know, in this environment that we've witnessed since this virus blew up, there's far more sectors have done badly than have done well. I mean, gold mining shines out as one that's done well because its revenues have gone up, its costs have gone down. The tech stocks have gone up because they can, you know, they don't need human contact. They can operate in the cloud, if you like, and their revenues, Netflix and Amazon's revenue. So there's been winners out of this. The pharma companies have gone up. Even a stock like Admiral, you know, there's no cars on the road, there's no accidents. So, you know, they're making more money out of coronavirus. It's not all losers, but there are a lot more losers than there are winners in terms of sectors. So if you're looking at ESG, a lot of ESG funds won't touch mining. But again, you know, if you're going to move to electric cars, where's all the metal going to come to make these electric cars? Electric car uses 4 times as much copper as an ordinary car. So if you're an ESG fund and you don't like mining, but you like electric cars, well, it doesn't add up. So it's possible. I mean, not everyone's views on what's ESG and what's not ESG are the same. So can an ESG fund could buy Rio Tinto zinc on the basis that it's not a stock you would traditionally associate with ESG, but as I say, or Antofagasta, where's all the copper going to come and silver to make all these electric cars from? So I tend to agree with your point that it'll fade in the background because investors at the end of the day want to get a return on their money. And if they've got to buy things like mining stocks as one of the few sectors where they're going to outperform, then they just have to bite the bullet and redefine what ESG means to them. What do you think, Angelos?
I fully agree with you, and I have one point to make that ESG became very fashionable last year with all the move against climate change and the potential risks to the world, etc., and became almost a fad and a fashion sort of item for investors to ask into any investment and place it very high on the agenda. Now that we are battling a serious recession and we are battling the question, how do we get out of it and how do we get the economy back to work, I think this is going to fall way back down the agenda. Investors will focus on where does the money, where does the actual production output come from and how can we benefit from it. And we are not going to, shut our eyes and sort of pick anything that is doesn't pay any regard to ESG. ESG is here to stay, and most companies have it on their corporate agenda. But in terms of portfolio selection and investment selection, I think investors will be much more focused on profitability and growth rather than ESG credentials. And I'm not talking about, the ESG specialist funds that are constrained by mandate. I'm talking about the generalist investor and the big, sort of multi-disciplinary funds that can focus on any industry and any sector of the economy.
Yeah, but in turn, would you agree that the mining companies that have sort of cleared their ESG message and have got that as a large part of their presentation and their story, they're more likely to get this generalist capital or to sort of tick that box, if you like, as the generalist funds start looking to mining and real assets and other and the metal sector?
Yes, absolutely. I mean, as I said, the ESG is here to stay, and every management team is very conscious that they have some targets to meet and they want to improve the credentials of their company in terms of environment. And there's always an aspect of their presentation focusing on that particular topic. But the mining sector as a whole has been battling against a massive headwind over the last couple of years. That is, one of these industries where they cannot easily make a very dramatic shift towards a much more sort of even carbon neutrality over the medium term, because it's the nature of the industry. It's a highly capital intensive, highly sort of energy consuming industry in order to extract these commodities out of the ground. You cannot, there's so much you can do in meeting the environmental criteria. And then you focus on social and governance that are the sort of the softer elements of operations. And I think every mining company around the world nowadays, or any serious mining company around the world, has a very firm plan of action in that respect in their in the strategy going forward. So it is there and very clear in their message. Yep,
absolutely. Okay, great. Just wanted to come back to one other area, because we've talked about gold a lot before, and Ian, you mentioned silver and copper even, but silver and platinum, the other precious metals, offering a good opportunity at the moment. What are both your views on silver or platinum producers, developers, and do you think now is an opportune time to be investing in these companies? You're obviously quite bullish on silver, Ian.
Yeah. I mean, I think gold is going to go up. I'm not bearish on gold. I think gold is going to go up. I just think silver and platinum, in percentage terms, from here are going to go up a lot more. I mean, last time gold was at $1,700 an ounce. Silver was around $30, $35. It's currently $15. The gold-silver ratio is at the highest level it's ever been in recorded time. Some people going back to 2,000 years or something. And silver has never been this cheap relative to gold. And there's no reason, you can't say, oh, it's due to coronavirus, because it's been going on for quite a long time. There's no reason to justify the bombed out prices of silver and platinum. And platinum traditionally used to be more expensive than gold. Now it's half the price. So these are cheap. Things do get cheap, you know, and if you're an investor and you think you missed the boat with gold going up so much and gold miners, well, then look at some silver miners, because potentially at some stage, if they catch up, they'll do more than catch up. They'll catch up and overtake. And I think, yes, there's decent money to be made in gold shares, even in the big blue chips from here. But there's much more money to be made in mid-cap silver stocks. Because they tick two boxes. They're mid-cap and they're silver.
And there's not as many silver miners out there as gold miners, though.
No.
Does that make the work easier in terms of looking at who you're going to pick, or is it?
Yeah, I mean, a lot of the silver miners have also diversified into gold to help them keep going, because silver mining has not been particularly profitable over the last few years. So a lot of them have diversified. So there's less and less pure silver plays than there used to be. There aren't very many, but there are some around, and so a lot of silver gets produced as byproduct of zinc and mining and lead mining. But there are pure silver plays. Most of them are Canadian companies mining in Mexico. They're there, and you can find them, and potentially, I think you'll make more money buying silver mines here than you will in gold mine, personally. But I think you'll make money in gold mine as well. I think you just make more in silver mine.
I fully agree with Ian again. The only point I would make is that it's a function of volatility, and silver has historically and traditionally been much more volatile than gold, and we saw that again during the course of March. And it was in effect a replay of what happened in 2008. Silver crashed by something like 14-15% in a single day in March. I believe it was the 16th of March. And no one understood why. No one could tell why. It is a much narrower market. It's a much less liquid market than gold, and that's why it is much more volatile. And again, looking back in what happened during 2008, 2009, silver had a similar crash in 2008 with the financial crisis then. And then it took about 6 to 9 months lagging the gold price in 2009 until it started recovering. And 2010 was really the year of glory in silver, when it went up to $50 an ounce. So I expect something similar, I suspect rather something similar is going to happen with silver prices now. And as we start from a much lower level, with the gold-silver ratio being so high, at all-time high, at some point things will start developing for silver, and it could be much quicker than the last time around. It could be much quicker than that silver prices now start rallying. And then following on, it is true that there aren't that many pure silver plays around, but there are some companies that have a greater percentage exposure to silver in terms of their production mix between gold and silver. And these are the companies that investors will focus on when they see the silver price taking off. And again, it's the same old point about the margin expansion. As the silver prices start rallying and rising very rapidly, they produce a much greater expansion of profitability to the mining companies.
Ian, I'm conscious you might have had something on after this. Are you okay for time?
No. I mean, the only other point, which is slightly unusual, is, and one of the reasons silver is so volatile, is you got complete army of day traders and speculators trading silver futures because you get a lot more bang for your buck. So it's got a, I think it's speculative open interest is something like 1.5 years out global mine output, which is off the planet if you compare it to other commodities. And what you saw in the crash in March was the open interest in silver and gold, and quite a few other things as well, but particularly silver. The open interest collapsed as all these day traders got forced out of their positions, whether on stop losses or whether just to liquidate to pay margin calls on positions elsewhere. Now, as the market's recovered, the open interest hasn't recovered, and that's quite unusual because normally what happens is as the market bounces back, particularly in gold, which is roared on to new highs for the year, you would expect the open interest to start following it up, and it hasn't. It's half what it was at the start of the year in gold and silver. Now that's quite unusual, and that's actually quite supportive because it means that you haven't got this perennial stale bull position or overhang in the market, particularly in silver. So every time it goes up, you just run into profit taking. Because the speculative interest is only a fraction of what it was, which is unusual when you've had a market that's risen. You expect the open interest to gradually rise in line with the rise in prices, and that hasn't happened yet.
Interesting times for silver then. What about palladium? What are both your views on palladium? At the end of last year had a sensational run, problems going on in South Africa pre-COVID-19. Seem to spike that up. Do you see that as an interesting play right now?
Yeah, but the trouble is, like we don't buy the metals. We buy them. We did have a position in a company called North American Palladium, but unfortunately it got taken over just before the palladium price spiked. And there aren't many palladium stocks you can buy. I mean, you say about not many silver stocks around, and there's hardly any palladium stocks you can buy. So. We don't really want to buy the metal ETFs in the fund at the moment. We prefer to buy the mining stocks. So although it had this huge rise, we sort of only really participated in a very small way. But, you know, we're not.
Yeah, the only point I would make about palladium is that it faces a headwind at the moment in terms of demand from the auto manufacturers. We have seen a total collapse in auto sales. And palladium is typically used for catalytic converters. So the demand has vanished in the COVID crisis and no one is buying cars. So the question is how long will it take for the auto industry to rebound? You know, how quickly will consumers come out, start driving again and starting wanting to buy new cars? So it's a very difficult situation to sort out, but I suspect over the next few years demand should come back up and therefore return to palladium. And we know that palladium is in short supply, particularly with the production problems out of South Africa and the union and labor problems they have out there. It is expected that a shortage of supply will persist.
Yeah, that makes perfect sense. And then you also have an EV story that's hitting on the catalytic converter engine as a competitive element there. That could well have an impact on palladium. The other thing I wanted to raise, actually, Ian, you mentioned it just then on the ETF side of things. There was a commentary, you know, that a lot of passive money is going into metals and mining through ETFs rather than taking on the risk of moving into holding equities. Do you see that changing right now? And do you think that the smart investor would be brave enough to move, perhaps on the retail investor, should be brave enough to move out of ETFs and into mining stocks right now?
Yeah, well, if we're correct, and this is a big bull market in gold, holding the bare metal is about the worst. It's going to be the most underperforming asset of all, because all the mining stocks will way outperform holding gold bullion just on the metal of its own. Silver will probably go up a lot more than gold. Silver bullion will go up more than gold bullion, but gold mining companies will go up more than silver bullion, and silver miners will go up more than anything, potentially. So I mean, last year, I think our fund was up, I don't know, 50, 60%, can't remember now. Bullion was up 12%. I mean, and that wasn't even a proper bull market. If you get a bull market where gold goes up another 20%, these mining stocks are probably going to double. So you're missing out. If you're bullish on gold, you shouldn't buy gold. You should buy gold miners. Or if you're bullish on gold, you should buy silver, because silver will probably go up more than gold. So of all the sort of, if you have a league table of what goes up the most and what goes up the least in a gold bull market, gold bullion is at the bottom of the league. It goes up the least. So at some stage, but then if fear outweighs greed at the moment, that's what people are going to buy. But as the story gradually unfolds, fear will gradually get reduced and greed will gradually take over. And that's the time you'll see them want to make more money out of it and start to move into the mining shares. But at the moment, if fear is still the predominant factor, people are going to just stick with the metal, I would suspect. But that phase is about to come to an end, I think.
Yep. Let's hope so. Angelos, do you agree on the ETF front?
Yes. Clearly, we have seen a massive growth in gold bullion-backed ETF growth, fund holdings rather, and we have seen investors focusing on the large cap diversified gold miners, the Barricks, the Newmonts, Franco-Nevadas of this world, because again, people are cautious. They want to have liquidity. They want to have safety in size of company and size of balance sheet, rather than looking to smaller, less liquid companies. As the market develops and more people look to diversify and increase their allocation to mid-cap and smaller cap companies, then the share prices of those companies get re-rated much faster than the actual commodity. And it is logical to think that the smaller companies typically have a much higher average marginal cost of production. So if, say, Barrick has a marginal cost of production of $600 an ounce, a mid-cap or a smaller company might have $1,000 or sometimes $1,100 an ounce. So as the gold price rises, the impact on the profitability of each company is different. So as the profitability expands for the mid and smaller companies, their rating is much lower compared to the majors. So they become, even from fundamental sort of value-seeking investors' point of view, looking at profitability ratios and balance sheet ratios, they become much more attractive than the majors. And that causes the much faster re-rating. Okay, great. Well, it's quite clear then where the money should be flowing to at the moment if you want those excellent returns. Just to wrap up, what would both your thoughts be on the gold price towards the end of this year? We did touch on it earlier, but I just wonder whether you are expecting or could say whether you feel that it's plateaued for a little bit, or we're going to see it much higher by the end of this year.
Depends what you mean by much higher. I mean, I think we could easily take out $2,000 in the second half of the year. Does that constitute much higher, or just a bit higher? I mean, it's not that far away, really, in percentage terms. But certainly, I could see it taking out 2,000 and then pushing on into next year. So again, that's for gold. But if gold goes to $2,000 an ounce, and you bought it today at $1,700 an ounce, that's quite a nice profit. But as you keep saying, I think you'll make a lot more money in other pressures. If gold has that sort of run, at some stage, silver and platinum are going to kick in, and then you'll see far bigger percentage rises there.
Yep.
Well, I agree again. $2,000 is only 17–18% up from here, from where we are. So it's not a very difficult target to reach. And I think we will reach it very, very quickly in the second half of this year. But what I like to quote is Bank of America, who came up with a forecast of $3,000 an ounce within the next year and a half. And Bank of America is not your small high street bank. It's a major institution that does not give very bullish forecasts or targets very easily. So there is a growing band of significant investors and very sizable institutions that are getting very, very bullish on gold. And we also know that there was a lot of central bank buying over the last couple of years. And I have said it very often that these people, the central banks that is, are not traders. They buy the gold to hold in their reserve book and hold it to back their currencies. They are not going to sell even if gold goes to $5,000. So there is a lot less available gold in the market to provide the backing for all these ETF demand. The ETFs have to back the units they create for new investors with physical bullion. So as there is a scarce availability of physical demand in the market, prices could go up significantly higher very quickly.
Yeah. Okay, that makes a lot of sense. And I've had nearly an hour of your time, gentlemen. Thank you very much for that. We've covered a lot of ground. So I'd just like to say thanks very much for sharing your thoughts on precious metals in the markets and the mining sector at the moment. And hopefully we can revisit this maybe in physical format come November when we run one-to-one again. But until then, thank you very much for your insights and your input, and we'll push this out to the network.
All right.
Thanks very much.